is a weird paradox. Help me sort this out. I mean, on one hand, we have the battery metals. I'd almost say formerly nickel being dumped on, but nickel's still above $9, $9.19 per pound. Interestingly, for all of the consternation of the last 3 months, I mean, nickel doing a kind of a nice recovery here. But let's discuss the other battery metals which haven't recovered as much. Cobalt and lithium. A senior U.S. official accused China's CMOC group of using quote-unquote predatory tactics to depress prices by flooding the market with cobalt from DRC mines. So we have on one hand very cheap battery metals. So that's one side of it where there's concern that prices are too low on metals. And then on the other hand, we have copper, which all of a sudden was above, I think $5.18 is where we were last week. It has taken a big drawback, but we were that high and could go right back here. I mean, perhaps just a retrace to the scene of the crime here at Support, as the technical analyst Gareth Soloway would say, previous guest on the show. It kind of looks like a classic retrace to the scene of the crime where the breakout was. On the other hand, here we are concerned from a governmental perspective. Of course, this is great for the miners, as Peter Bryant, board chair of Clareo and the Development Partner Institute, is going to tell us in our feature interview. This is great for the miners, but for governments, this is kind of bad news for the economy, for employment, your job, potentially your business, right? Your life, your savings. If metals go up, this isn't exactly what we want either. Do we want $20 copper from a economic point of view? We might want it individually as stock investors or traders, or, if you run a mining company. But if you're not in that group, it's not good news. It means prices are going up. If you're a car manufacturer and you have $20 copper, that's a bit of a concern. And it seems to me the reason we have what I would call divergent ways of thinking here. On one hand, cheap metal prices are bad in the case of cobalt and lithium, but expensive metal prices in the case of copper is also bad. So which is it? Do you want cheap metal prices or expensive metal prices? I would say we want cheap. And rather than criticizing when nickel goes down from a governmental perspective, there's a very simple market solution, which is to buy it. If your concern is that the Chinese government is subsidizing nickel miners through, these processing facilities in Indonesia funding, or, suppressing cobalt prices or lithium, flooding the market, this has been around at least since rare earths back in 2010. This is what we lovingly call the playbook here. And so if that is the concern, there is a very easy market solution to this, and that is to stockpile. If cobalt is very cheap, and this is a critical mineral that you think you might need as a critical metal for military reasons, for supply chain reasons, it's something you need, you take advantage. If nickel goes to $7, as we were saying, you buy it. That is the obvious solution here. What was it, $7? Now you're at $9.19. Okay, what is that, 30%? I think cobalt's another obvious example, or lithium. Just buy it. You're the government. These are metals. One assumes that if you keep them under good storage conditions, I would imagine you could store this stuff for relatively low prices. And there you put down your ace, your joker card. You've laid it down on the table for China's government if you're worried about them subsidizing their miners and saying, no problem, thanks for subsidizing our metals. We'll take it all. We're going to print some money and we're going to take it all. What do you think of that? Do you think that would solve the problem? It kind of feels like at least it might help. Now, it should also be a double-pronged strategy, I would argue. I was watching this video and I wish I could remember the name of this exploration company. It was in Europe, and it was kind of to a certain degree sad because there they were pitching for this EU critical metals fund that we were discussing last week, where the EU had a meeting, and basically what they said is we're going to reduce permitting times. Remember, 2027 is now going to be the limit on a permit. I guess that's progress, so we'll call it a good news story. if you're making a permit in 2024 and you still have to wait 3 years, I'm not sure how much that's helping, but let's call it progress. So this exploration company on Twitter was basically making a pitch. It's almost like, Dragon's Den or, Shark Tank, pick your thing. And in that respect, it was kind of sad. But nevertheless, here's this company and they're saying, hey, we have a shot because not only is the EU going to reduce permitting times, they're also offering funding. Whatever that means, whether that is loans, whether that is grants, I don't know. And again, I think there is a default reaction from the mining sector, which is very entrepreneurial. And frankly, I share it, which is we don't really want the government involved. That is the default. However, the government is involved on the other side, is kind of the reality. They seem to have an active strategy here. It's been going on for arguably 15 years. And it worked beautifully with rare earths, and they just keep on employing the same tactics over and over. Flood the market, put everybody out of business, then you own the market, right? So the real solution to this, again, is to stockpile. Now you say, well, should we allow China to enter the car market? And really, as I think Elon Musk said, as we quoted here, I think he said the word was demolish the car industry if tariffs aren't employed. That's how serious this is. Again, there's a $9,700 car. I believe it's sold locally to Chinese, and they're still making a profit. By the way, BYD on this car. I think it's called the Seagull. So you could say, well, should they be allowed to do that? The real long-term fix of this is actually getting to costs. And one thing where the West is probably going to have a really difficult time competing is going to be on labor. But perhaps that will be replaced by robots. This may not save anybody's job, but at least in theory, that could be replaced by robots because at the core of the price differential, I would argue, are the components and whatever energy/labor it's going to take you to make that car. But at the core of your car costs that are irreducible, that you don't control, and arguably you may not even be able to innovate your way around, are these metals. So with all that being said, the common sense strategy here is you buy the cheap metal. Right now, cobalt is cheap. Buy it. I mean, the Chinese government, and we'll get into a story in a second here. Here's the headline. China plans biggest ever cobalt purchases for state reserves. You employ the same common sense strategy that China is employing. There's nothing brilliant about what China has done, I would argue. The results, you could argue, are brilliant, and the execution is brilliant, but the original thought that, hey, we should buy up as much metal as we can, it's historically cheap, that's not rocket science. That's just called foresight. So now the thing to do with foresight, now that the West is in this bind, is you buy the metal. If China wants to sell a nickel at $7 a pound, we don't make a fuss. We say, thank you very much. Everything looks fine over here, and we stockpile it. If they want to flood the market with battery metals, we say, I can't believe how lucky we are. And you buy it. And what that'll do, one would assume, is it would keep the price above a certain level with increased demand. And if China wants to do it for the next 10 years, it's like, no problem. We'll turn on the money printer. What are we spending all this money on anyway? At least we're getting something real for our dollars spent here. This isn't a bridge to nowhere. This is metal. We resell it for whatever it costs us to do all these transactions and the metal price, and you sell it to local manufacturers. And what'll that do is it'll buy you time in order to start catching up, because one thing the West has to remember here, they're starting this race like 15 years after China started. And there's kind of an incumbent advantage here. Who has all the smelters? Who has the refiners? So let's take a look at this story here. China plans biggest ever cobalt purchase for state reserves. This is Bloomberg News via mining.com. China is preparing to snap up a record volume of cobalt for its state reserves this year, with prices of the battery material languishing near the lowest levels since 2019. The National Food and Strategic Reserve Administration, which oversees the country's official commodities stockpiles, is preparing to buy around 15,000 tons of refined cobalt, according to people familiar with the matter who declined to be named. The purchases could begin in the coming month, and the price of the tender is expected to be between 200,000 won and 220,000 won, the people said. That equates to about $12.50 to $13.80 a pound. So cobalt has been languishing here for at least a year at these prices, and now China's going in and saying, we'll take 15,000 tons, thank you very much. The common sense thing to do. The article continues, the National Food and Strategic Reserves Administration didn't respond to a faxed request for comment. I mean, the fact that it's a faxed request, the fact that they have a fax, to me is a mildly alarming detail. The planned purchases were reported earlier by Reuters, and so no comment. The metal used in everything from electric vehicle batteries to aerospace alloys has slumped to 5-year lows amid booming production in Democratic Republic of Congo and Indonesia, where it's a byproduct of copper or nickel mining. China accounts for about 4/5 of global refining. And interestingly, a couple of paragraphs down, a worldwide glut in cobalt widened to about 14,200 tons in 2023. So last year there was a glut of 14,200 tons. Perfect. We'll buy 15,000 tons. Shouldn't even move the market that much, hopefully. I think China, when they see low prices, they're probably excited. Battery materials have suffered broad declines in the past year. Cobalt is also among metals considered critical by Western nations trying to loosen China's supply chain dominance and avoid future shortages. Earlier in May, a senior U.S. official accused China's CMOC group of using quote-unquote predatory tactics to depress prices by flooding the market with cobalt from DRC mines. CMOC, which last year overtook Glencore as the world's top producer of the metal, said in March that its DRC mines will produce 60,000 tons of cobalt this year. To use the cliche, it's just a bit of a checkers chess situation here, I would argue. Now, let's continue on. We have another cobalt story, and this is related to these very interesting allegations by the DRC, the country itself, against Apple. And here is the headline. This is a staff writer at mining.com. Lawyers representing Congo claim to have new evidence on Apple's use of conflict minerals. International lawyers representing the government of the Democratic Republic of Congo said on Wednesday that they had new evidence from whistleblowers which deepened concerns that Apple could be sourcing minerals from conflict areas in eastern Congo. The Amsterdam and Partners LLP law firm has been investigating allegations that minerals mined in Congo by several companies and armed groups are being smuggled out through Rwanda, Uganda, and Burundi. Congo lawyers notified Apple CEO Tim Cook on April 22nd about a series of concerns regarding its supply chain and also wrote to Apple subsidiaries in France demanding answers within 3 weeks. And here is Congo lawyer Robert Amsterdam, quote, "It is more urgent than ever that Apple provide real answers to the very serious questions we have raised as we evaluate our legal options. The absence of a response is an implicit admission that the questions we asked Apple were relevant," end quote, added William Bourdon, another lawyer representing the country. In today's press release, and this was written on May 22nd, the DRC's lawyers painted Apple's silence, quote, as a testament to the company's embarrassment in providing accurate answers beyond the banal and predictable rhetoric of denial served up by Apple's spokespersons 4 weeks ago, end quote. And I remember that response, and it's not a terrible characterization of that response by Apple. It was banal. It seemed to avoid the whole thing as if they had triple-checked their 3T minerals, as they are called. Apple has said in the past that it does not directly, and probably the key word here is directly, buy, procure, or source primary minerals, and it has been auditing its suppliers for several years and publishing its findings. So just another side to this whole cobalt story. So continuing on, there was a story in the FT that I think was quite interesting, and it speaks to this whole exchange issue. I think we're in a liquidity market. And what I mean by that is the market wants liquidity. You know, why did Anglo American have such a low valuation? People are suggesting perhaps it's because it's on the London Exchange. I mean, Total Energies in France is suggesting moving over the New York Stock Exchange. Shell is considering delisting in the UK and relisting on the New York Stock Exchange. In fact, we have a story from 3 weeks ago. European oil giants consider shifting their listings to the U.S. This is the New York Times on May 6th. Total Energies and Shell are contemplating the advantages of listing shares in the United States to strengthen what they say are low market valuations. And you could argue the whole reason Anglo American's share price was so low perhaps was because it was listed in London. And this rings true, doesn't it? Because if you think about your own, stock adventures, if you buy on a phone, like many people do these days, you'll know that the New York Stock Exchange is a bit more attractive as an option as far as buying on your phone than, Frankfurt, London, Paris. It's not really top of mind when you're buying stocks on your app, even ETFs. All of the liquidity, so to speak, all of the action seems to be happening on the New York Stock Exchange. There's a lot to be said for this, and the argument could be made that part of the reason exploration companies have been suffering is because of listing on something like the TSX Venture, one could argue. And so it's just a very interesting trend. So going back to the Financial Times, here's the headline. Activist investor calls for Rio Tinto to abandon primary London listing. Palliser Capital says miners should unify corporate structure in Australia to boost share price. So rather than going to the New York Stock Exchange, so it's not just the New York Stock Exchange, Australia is also seen as an attractive place for some reason for capital. And here's the start of the story. Rio Tinto should abandon its primary London listing and unify its corporate structure in Australia, echoing a move by rival BHP, according to an activist investor that has taken a stake in the dual-listed miner. Palliser Capital, a UK-based fund, said on Thursday that Rio's current dual corporate structure was a barrier to its strategic plans, which made it difficult to do major acquisitions and meant the London-listed company was trading at a $27 billion discount to its Australian entity. Unifying the entities and consolidating the primary listing in Sydney, as rival BHP did 2 years ago, would result in the FTSE 100 losing the world's second largest mining company. And they could also lose Anglo should that deal go through. So it's a market that really wants and needs liquidity, so to speak. It doesn't seem to be a market for, the fringe investment, shall we say, there. So, and finally, with BHP, they're, significant news, but not a huge amount of news. Basically, Anglo American has rejected BHP's third proposal. However, they have offered to extend the deadline of talks until May 29th, so extending it a week. And this was apparently encouraged by BlackRock as well as other key shareholders, according to a Reuters article on mining.com that is quoting the Financial Times. And the two other significant shareholders are 91 and Sanlam Investment. And I think BlackRock had something like 9.6% of Anglo shares. So people don't want to see it dead yet. And finally, on this point, we have a quote from JP Morgan South African mining analyst Catherine Cunningham. And she wrote, quote, "There is now a materially higher probability that BHP will reach an agreed deal." So interesting developments there. It continues to be a wait and see situation, but it is a developing story. And again, the deadline is now tomorrow, Wednesday, May 29th. So more news on the way. With that, if you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Apollo Silver President and CEO Tom Peregoodoff for this week's CEO Spotlight. Joining us today, I'm very pleased to welcome back to this week's CEO Spotlight, Tom Peregoodoff, President and CEO of Apollo Silver. Tom, welcome back to the show.
Adrian, good to be back. Thanks very much for the time.
Well, it's wonderful to hear from you. Of course, silver is making a lot of headlines right now, and you are president and CEO of a silver company. So tell us, for those that aren't familiar with Apollo Silver, what are you up to and where are you doing it?
We are a TSX Venture listed pure play silver group. Our focus is in the U.S. We do like stable jurisdictions. We took on the Calico Silver Project in San Bernardino County, California, And since we took it on, we announced a very significant silver resource back in 2023. We've got a total of 110 million ounces in measured and indicated. 90 million ounces of that is in measured. So we're now looking to advance Calico into some pre-feasibility type studies, and we'll look to sort of get that work underway in the coming months.
Okay, excellent. So you've started drilling then. What comes next on your journey? What's top of mind for you as you work on the project? Tell us a little bit more about your flagship.
Well, look at, as I said, the Calico Silver Project, it's composed of two resources. The Waterloo Project, which we bought off of Pan American back in 2021. And that's where we have identified the 110 million ounce resource. We've really focused on Waterloo. There's a second resource. The neighboring property is the Langtree property. We have an additional 51 million ounces of silver in the inferred category there. We're the first company to ever own both of these tremendous silver resources. And so, now for us, because we've done a lot of the de-risking from the resource side, really now it's around getting a second phase of metallurgical work underway, getting that geotech work underway, and all those inputs that we can then get into the pre-feasibility study. A number of people ask me, well, are you going to go and publish a preliminary economic assessment initially? And because we've got such confidence in the resource, we've drilled it out to about 200 feet by 100 feet, so 60 meter by 30 meter spacings, which is very adequate for this style of mineralization. So I'm comfortable now that we can move straight into pre-feasibility work.
And as far as permitting is concerned, where do you guys stand on that front?
Permitting, obviously, top of mind, I think, these days for everybody. And when you mention that you're operating in California, I think it becomes even more so. And there's a few things that, separate us from a number of the other groups that might be trying to operate in California. I think first and foremost, we're in the right county. San Bernardino County is about as mining friendly as you're going to get in the U.S. Just as an example, to give you a sense of what I'm talking about, all of the aggregate and limestone for concrete for the Southern California construction industry is sourced from San Bernardino County. In addition, you've got people like Equinox and their Castle Mountain operation in San Bernardino, as well as Mountain Pass, which is that rare earth operation. So a good jurisdiction. And that's really, for us, that's really helped by the fact that we're on private lands. In the case of Waterloo, it is fee simple lands, which means I'm the landlord. I'm paying property taxes. And in the case of Langtree, it's all patented claims that resource sits on. So that means that my first port of call, as far as permitting is concerned, is with the County of San Bernardino as the lead agency. To give you a sense and to give, people who are listening an idea of fundamentally what this means in very real terms, in 2022, we commenced our 10,000 meter drill program and we permitted that drill program. We received our permits to drill within 6 weeks of application. I've recently applied for amendments to those permits to give me another 12 months to get some geotech drilling completed and some additional exploration drilling at Langtree. And those amendments and those annual amendments took about 5 weeks to grant. Okay, now compare that to Arizona, which is known as very mining friendly, and people are waiting a year plus. I know one group that waited 2 years to get exploration permits to drill and get their plan of operation approved by the Forestry Service in Arizona.
So just finally on the project itself, so we're above $31 on silver here. What does that mean for the outcome of your project?
I'll be very clear. When we bought this project in 2021, on the back of the transaction, we raised $53 million and people like Jupiter out of the UK were a big supporter. None of us bought this resource for $23 silver. We all knew that silver, when it reached the sort of levels that we're seeing now, is when this type of resource would really come into its own. So for us, $30 silver is really, I think, going to be the key that's going to unlock this tremendous resource. And a lot of interest is starting to come in about this resource. The phone is starting to ring much more frequently.
I would imagine. Okay, so then what's the roadmap here then? How do you see things playing out over the next, say, 6 months to 2 years or longer?
Okay, sure. Well, look at, I think that, investors need to keep an eye on us as we look, beyond Calico as well. We are looking at some M&A opportunities. Once we find a transaction that fits, we'll be looking then to get that final plan in place to commence the pre-feasibility type work. And that's a second phase of met sampling, which we already have the material for that. And then the geotech drilling. And we'd be looking to put that study out sometime in I'm fairly conservative. So I'll say, second quarter of next year, which is really going to be then the trigger for us to get deep into the permitting. In the meantime, on the permitting front, we've already done kind of what we call a fatal flaw analysis. So we know that we have a very good understanding of the flora and fauna. I'm happy to say there's no Joshua trees, which is always a major concern in this part of the Mojave. Where we're at, we don't have any of that. So you'll see us start to get more activity going as far as permitting is concerned around archaeological surveys, continued engagement with the Mission Indian group, the San Manuel, and the Morongo groups down there. We've got a good relationship with them. In addition to that, I think people should look and keep an eye on us as we continue to advance some of these M&A type conversations that we're having.
Okay, excellent. So as we wrap up then, Tom, what is your message to investors? Like, what would you like them to know about Apollo Silver?
Look, I think that the key message for investors really is if you're looking for leverage to silver and if you're looking for a safe jurisdiction, I can't think of a better pure silver play opportunity that is really primed to get tremendous torque from the market that we're seeing in silver. And I think Apollo is, rings a lot of bells for people who believe in the very strong silver story.
Okay, excellent. And if people want to learn more, should they go to your website? If they want to talk to someone, what should they do?
First protocol would be the website. The deck is always up to date there, and there's contact information there that they can reach out and talk to me or some of my colleagues if they've got specific questions.
Tom Peregoodoff, President and CEO of Apollo Silver, thank you for joining us on this week's CEO Spotlight.
Thanks very much again for the time, Adrian. Enjoy the rest of the day.
And thank you once again to Apollo Silver for sponsoring this week's episode of the Northern Miner podcast. Turning to the website, copper price steadies after biggest decline in almost 2 years. This is Bloomberg News via mining.com. Copper steadied following the biggest drop in almost 2 years as Chinese factories balked at paying record prices and Federal Reserve officials made hawkish comments on inflation. The metal surged to an all-time high above $11,000 a ton on Monday as bullish bets put pressure on holders of short positions to close out their trades. That was followed by a slump of 4.1% on Wednesday, the most since July 2022, amid profit-taking and signs of weaker demand in China. Factories in the world's biggest metal consumer are struggling to pass on the surging costs of copper to clients, making products ranging from air conditioners to home electronics. In the U.S., minutes from the May Federal Open Market Committee meeting showed concerns over, quote, disappointing, end quote, price increases. The central bank may hold rates higher for longer, quote, should inflation not show signs of moving sustainably toward, end quote, its 2% target. That should put a dampener on global economic growth. The record rally for copper was, quote, showing signs of easing, end quote, Jin Rui Futures Company said in a note. Still, China vows to step up stimulus along with expectations supplies will tighten, the firm said. So copper pulling back. And then we had another headline. Copper price could surge to $40,000, says top trader Ann Durand. This is a staff writer on mining.com. Copper prices could reach $40,000 per ton in the next few years, hedge fund manager Pierre Andurand told the Financial Times. The metal has risen almost 20% this year, reaching a record $11,000 per ton, or $5 per pound, this week. Quote, we are moving towards a doubling of demand growth for copper due to the electrification of the world, including electric vehicles, solar panels, wind farms, as well as military usage and data centers, end quote, the top trader told the Financial Times. Andurand, a former Goldman Sachs trader who co-founded Blue Gold Capital before launching Andurand Capital, manages approximately $2 billion in assets. Quote, I think we could see prices up to $40,000 per ton, which is $18.18 per pound, over the next 4 years or so. I'm not saying it will stay there indefinitely, Eventually, we will get a supply response, but that supply response will take more than 5 years, end quote. I think the government really needs to decide, do we want high prices or do we want low prices? In another bullish analysis, Jeff Curry, former Goldman Sachs executive and more recently chief strategy officer of energy pathways at asset manager Carlyle, told Bloomberg News in an interview last week that copper, quote, is the highest conviction trade I have ever seen, end quote. Curry sees copper prices reaching $15,000 a ton, or $6.80 per pound. The demand for copper in the transport sector alone is projected to increase by 11 times by 2050 compared to 2022. Electric vehicles, for example, can contain more than a mile of copper wiring. Additionally, the demand for copper needed to expand the global electricity grid is projected to increase by 4.8 times by 2050 compared to 2022. By 2030, the copper supply gap is projected to approach 10 million tons, according to Bloomberg NEF estimates. So, pretty interesting. And another interesting story here. China defies global copper squeeze with near record production. This is Bloomberg News via mining.com. And you have to think, China is the manufacturer to the world for the most part. And I would think a high copper price would destabilize their situation. And so let's take a quick look at what it says here. The global copper market is gripped by fears of a shortage, which has propelled prices to record levels and sparked a $49 billion takeover battle. But in China, the world's biggest producer and consumer of the refined metal, there's more than enough to go around. At the center of that conundrum are the nation's ever-expanding copper smelters. The industry is maintaining production at near record levels, defying a scarcity of raw materials as higher prices unlock more scrap metal for processing. So scrap metal making up the difference. Smelters had pledged to reduce capacity after their fees collapsed because of a supply squeeze on the imports of ore they use as feedstock. The prospect of insufficient copper in China is just one of the pillars supporting a barnstorming rally that took the metal above $11,000 a ton for the first time at the start of last week. But the cuts haven't happened, and China's faltering economy isn't able to absorb the excess. The mismatch between supply and demand has become more glaring in recent days, with prices retreating to just above $10,300 a ton. Although there's still a 21% gain for the year, it suggests that as long as China remains oversupplied, copper will struggle to make further headway. The availability of scrap from discarded pots, pipes, and wires has risen quickly after copper prices surged, said Liang Kaihui, an analyst with Shanghai Metals Market. Fabricators have been busy turning that into blister, a semi-processed version of the metal, and feeding it back to smelters, he said, where it's used as a substitute for the overseas ore that's now in short supply. The abundance of scrap is seen in its discount to refined copper, which blew out to $637 a ton last week, the widest in at least 8 years, according to Shanghai Metals Market. So scrap had the widest disparity in prices with refined copper last week, so more scrap is coming online. Finally, the smelting industry, meanwhile, keeps adding capacity. As long as they're profitable, individual firms prefer to defend market share at the expense of margins. Local governments also want them to keep churning out metal so that they can meet their economic growth targets and maintain employment levels. So, very interesting there. And finally, on the copper story, CITIC Metal to sell up to 2% stake in Ivanhoe Mines. And they own close to 25% of Ivanhoe's Class A shares, and they're going to sell 2%. With Ivanhoe at almost $20, you imagine they're probably, taking care of their costs. Probably a smart move there. Continuing on, Trafigura faces off with aluminum bulls over huge metal stash. So this story persists, and this is Bloomberg News via mining.com. The aluminum market is caught in a clash between some of the biggest traders and banks, with more than $1 billion of metal changing hands while lengthy queues form at the London Metal Exchange warehouses. The big bear in the market is Trafigura Group. The commodities trading giant has delivered massive volumes of aluminum onto the LME in recent weeks while touting its downbeat view. On the other side stand banks and hedge funds including SquarePoint Capital, Citigroup, and JP Morgan Chase, which have responded by buying up Trafigura's metal and ordering it back out of the warehouse system, according to people familiar with the matter. The result has been a major change in who owns the world's aluminum inventory at a time when some are predicting shortages ahead. It's also heralded a return of the stockpile battles and warehouse queues that have been regular hallmarks of the LME aluminum market, causing controversy among buyers and headaches for the exchange itself. The ballooning backlogs at facilities in Port Klang, Malaysia, mean that traders could now have to wait many months to take delivery of stock. The events of the past few weeks have been the climax of a trade that began many months ago. Trafigura has been accumulating a stockpile of aluminum in Port Klang over the past year, much of it from India, where the trading house has large contracts with suppliers including Vedanta. Trafigura's trade wasn't a secret. The growing stock of aluminum in Port Klang, a key global hub for aluminum storage, were visible in the LME's monthly report on metals stored outside its network of warehouses. But nobody in the wider aluminum market knew exactly what Trafigura would do with the metal. Often traders accumulating large stashes see opportunities to profit from increases in the physical premium that buyers pay over and above the LME price. If demand outstrips supply, the location-specific premiums tend to rise as real-world consumers of aluminum draw down metal that's held in stockpiles. Instead, in the past 2 weeks, about 650,000 tons of aluminum sitting in Port Klang was suddenly transferred onto LME warrant. Trafigura was the key player behind the deliveries, which led to an increase in live warrants of more than 500,000 tons on May 10th, the largest single-day delivery onto the LME in at least 27 years. So Trafigura makes a huge delivery of aluminum on May 10th. A few days after the deliveries began, Trafigura laid out its bearish outlook at a conference in London. Analyst Henry Van predicted that aluminum prices would fall, saying it was seeing, quote, a very grim demand picture right now, end quote, and noting recent smelter restarts. But other traders are taking the opposite view. Of the metal delivered onto LME warrant in the past 2 weeks, about 400,000 tons, worth about $1 billion at current prices, was quickly requested for delivery out again. The buyers include hedge funds SquarePoint and banks like Citi and JP Morgan, the People said. I mean, this is, I would argue, how small the dollar amounts are. This massive amount of metal costs $1 billion. I mean, what is that within the context of our current government budgets? Continuing on, in the short term, the buyers of the aluminum in Port Klang are likely to use it for so-called financing deals, holding physical aluminum and selling high-priced futures. And then scrolling down a few paragraphs, the decision to offload the mountain of stock onto the LME has puzzled many of Trafigura's competitors in the aluminum market, and the scramble to get hold of it has underscored its value to rival traders. Facing soft trading conditions in the physical market, Trafigura may have taken the view that the quickest and most lucrative way to turn a profit on the metal would be to sell it on the LME and collect a share of the rent from future owners. Traders delivering large volumes to the LME generally enter quote-unquote rent share deals with the warehouse company they're delivering to, meaning they earn a share of the revenues for as long as the metal stays in the warehouse. At a rent of 56 cents a day, the total rent on 650,000 tons of aluminum could be worth as much as $133 million a year, more than $200 a ton, as long as it stays where it is. Of course, that didn't happen. If it's all requested for delivery, however, the total earnings would be a fraction of that amount. So interesting shenanigans in the aluminum market. Also, we're seeing rising stocks of tin in China, especially in the Shanghai Futures Exchange. So we have a headline here from Reuters: rising stocks strike a dissonant note in tin's bull party. So tin has done quite well this year, up 32% on the start from January, but there is a concern that a growing amount of the metal is accumulating in Shanghai. Exchange inventory is the highest it's been since the launch of the Shanghai tin contract in 2015, and by some margin. The previous record in 2017 was just 11,000 tons, and now it's almost 18,000 tons. So there is a massive amount of tin in Shanghai. Continuing on, interesting headline here as we wrap up. Zimbabwe state miner says lithium assets attract investors. I'm kind of interested very much by Zimbabwe. I think they're getting this almost echo effect where the Democratic Republic of Congo has really taken charge on developing its minerals. Then you saw, to the southeast of them, Zambia started getting pretty serious, where there's also the copper belt. And to the southeast of Zambia is Zimbabwe. And you almost wonder if there is just a bit of a Me Too thing going on here. So just an interesting headline to see here. And here's a quote from Kuvimba Resources, which is Zimbabwe's state-owned miner. And this is a quote from the CEO, Trevor Barnard, who said in an interview, quote, "It's not just China, but from other nationalities as well. We are working on a structure that can accommodate a number of possible investors, and those investors will be able to take a portion of the resource that is available at Sandawana and develop that," end quote. Very interesting. Few headlines. U.S. Congress to fund $2 million Pentagon study on deep sea mining. That's by a staff writer at mining.com. Another headline, NGO sues Norway over deep sea mining plans. This is by Cecilia Jamasmy at mining.com. And the WWF is suing Norway over its plans for seabed mineral exploration. And they say that the country has failed to test the possible impacts of such activity and that it breaches national law. And here's a quote from Caroline Andor, chief executive of WWF Norway, who said in a statement, "We believe the government is violating Norwegian law by now opening up for a new and potentially destructive industry without adequately assessing the consequences. It will set a dangerous precedent if we allow the government to ignore its own rules, override all environmental advice, and manage our common natural resources blindly." And the first licenses in Norway are expected to be issued in 2025, but mining will not start until 2030 and will require Norwegian's lawmakers' approval. So those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.47%. That is 0.03% higher than last week. The UK 10-year gilt is also higher, yielding 4.24%. That is 0.08% higher than last week. And the Italy 10-year bond is also higher, yielding 3.88%. That is also 0.08% higher than last week. So 10-year yields rising. Turning to precious metals, gold is trading at $2,346.20 per ounce. That is $85 lower than last week. Silver is trading at $31.79 per ounce. That is only 9 cents lower than last week. So silver is showing some more strength than gold on the week. Interestingly, platinum is trading at $1,065.40 per ounce. That is $19 higher than last week. So higher. And palladium is trading at $996 even. That is $24 lower than last week. So a bit of a mixed bag, more a tale of many markets on precious metals. Turning to industrial metals, copper is trading at $4.83 per pound. That is 27 cents lower than last week. Iron ore is slightly higher at $117.66 per metric ton. That is 64 cents higher than last week, so barely any change in iron ore. Aluminum is higher at $1.21 per pound. That is 2 cents higher than last week. Lead is lower at $1.04 per pound. That is 2 cents lower than last week. Nickel is also lower at $9.19 per pound. That is 52 cents lower than last week. Tin is at $15.07 per pound. That is 47 cents lower than last week. Cobalt is unchanged at $12.32 per pound. Lithium is slightly lower at $14.56 per kilogram. That is 3 cents lower than last week. Uranium is slightly higher at $91.65 per pound. That is 70 cents higher than last week. And zinc edges lower at $1.39 per pound. That is 3 cents lower than last week. Bit of a mixed bag everywhere on this market. Slight correction in gold, while most metals basically edge sideways. But, each market showing more of its individuality as the metals complex as a whole edges sideways. And those are your metal prices. Coming up, I'm very pleased to welcome for the first time to the Northern Miner podcast, Peter Bryant, board chair of Clareo and the Development Partner Institute. Peter consults with government and with CEOs and with many other people. We have a wide-ranging discussion on many of the topical issues that the mining industry faces, including how green metals might come about, Where are the supplies going to come from? The strange disparity in interests between government and miners. In a sense, what's good for the goose is not good for the gander. The mining industry could benefit enormously from these prices, while economies and governments in turn struggle. So a very interesting discussion with Peter Bryant. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome for the first time to the Northern Miner Podcast, Peter Bryant, board chair of Clareo and the Development Partner Institute. Peter, welcome to the show.
Adrian, thanks for having me. A delight to be here. A lot going on in the industry.
There sure is, which is why it's wonderful to have people like you to help bring us insight into what's going on. And so for those that are not familiar with Clareo and the Development Partner Institute, tell us a little bit about what you're doing and maybe how it relates to mining.
Okay, thanks, Adrian. Yeah, so Clareo, we're a boutique strategy consulting firm that provides expert advice to the mining and energy industries globally. And the Development Partner Institute is a non-profit that I co-founded with Mark Kudafani. It works really with helping transform the industry to one of a development partner and improving social economic outcomes, in particular for Indigenous communities around the world. So have a unique position. And primarily I'm working with CEOs around the world and governments on critical minerals and what it means in terms of the demand curve with the energy transition. And that includes, we're content partners for the Future Mineral Forum in Saudi Arabia. That's one of only 4 organizations, as well as we've just formed an informal coalition in Washington, D.C. called the Key Minerals Forum, supported by 6 mining companies, really working with the U.S. government on bringing education and helping develop a more coherent strategy for the U.S. government towards critical minerals. Yeah.
Indeed. It sounds like you're very much involved in facing this challenge that around the world that many governments are facing in terms of kind of reshoring the supply chain, helping get the minerals they need, the whole green transition, and how do we, get the minerals, the copper that we need. So tell us, just to maybe big picture here, I mean, it sounds like you talk to a lot of CEOs. Like, what is the mood out there?
It's interesting, Adrian. I mean, obviously, we all know with the energy transition, it's kind of driving unprecedented demand across a broad range of minerals. Particularly I talk about the copper famine, copper, nickel, lithium, but also iron ore, aluminium. I mean, the demand curve is fantastic. So I think overall, the mining industry is probably, quite bullish with itself. I think, though, there's technical challenges in growing supply, finding new resources, and finding the right amounts of capital to invest to meet the demand curve. So I think the industry, is probably happy in one way because I think there's, probably some really good profits around the corner, but B, kind of a little perplexed in terms of overcoming some of the technical challenges, some of the capital deficits that exist in the marketplace.
I love that term that you used, copper famine. We've been hearing about it for years, that there's going to be a real deficit in copper, that there's basically not going to be enough. We need higher copper prices. And then it seemed to go nowhere for a couple of years. And then all of a sudden it went somewhere a couple of months ago. And then, of course, we got that BHP Anglo American, maybe will be an attempted acquisition here. What is your sense then, to drill down a little bit then, say on the copper market, and if you can, BHP and Anglo, how they fit into that whole story?
It's really interesting, Adrian. I think really puts a spotlight on copper and the whole copper supply curve. So the copper famine, it's pretty dramatic. Depending which analysis you look at, current production's around 20 plus million tons a year. That needs to grow to like 40 plus million tons by 2035. And there's a 10 million ton per annum deficit. Just to put that into concrete numbers, that's 105 million EVs a year shortage, or 23 times the Californian grid if it's on wind. So, just to kind of give it some picture on the end use of it. So I think what it shows, one, I think Mark Bristow in the FT recently said you can't consolidate your way to supply growth. So I think that's an important thing. So I think what the spotlights for me is, one, is the only path to grow your copper production really in the next 20 years is A, through acquisition, and B, through brownfield expansion. There are just no major copper resources to be developed. And the only major one really is your resolution, and that's really on hold in the United States. So I think what that is showing us is to get to the bulk that they need, they're going to have to get through acquisition, unlike in iron ore where there's just tremendous development of existing known reserves with a little bit of acquisition. I think what we're going to see is probably the next 3 to 5 years, a lot of consolidation in the industry.
Interesting. To Mark Brissow's point, though, like, will acquisition produce more copper? Like, is the idea you'll acquire projects that are in development, let's say, and then those will be brought online? Because I think if I remember what you're saying right with Mark Brissow, I think it's like this idea, like, we can do all the acquisitions we want. It doesn't add up to more copper, right?
Yeah. No, it doesn't. Yeah, I think what this does do, though, is because my belief is the biggest expansion opportunity in copper supply is actually, brownfield expansion and also increasing production out of existing sites, actually. So I think there is a theory you could say that as you bulk up, you get a certain level of scale, which allows you to kind of invest in the innovation needed to unlock that. But, there's some big challenges. I mean, what we're seeing in the major existing copper mines is production is declining, declining grades, increasing depths, increasing difficulties. So what we're seeing is not a linear level of production, but declining production. And brownfield expansions are increasingly difficult. I call it grade, depth, and distance. So grades declining, depths increasing, and distance of brownfields being further and further away from the actual processing plants, which actually make it uneconomic. So there is an argument. I remember Darren Woods, the ex-CEO of Exxon, said that when you get to a certain level of scale, it enables you to drive the kinds of innovation that are needed to overcome some big technical challenges. Whilst you were speaking about the oil industry, I think the same thing applies here in copper, that I'm hoping once BHP gets to a certain level of production, it leans into the investment and innovations needed.
Okay, so let's go to the BHP Anglo deal then. I mean, I don't know if you have any big picture thoughts on this, but when I look at it, and I think it's been commented on a lot, I think the two words that are most commonly used, and I think accurately, it's a very ambitious and complex deal. It seems almost like too ambitious to a certain degree. It seems too complex. Of course, now Anglo is starting to divest some assets, so maybe that simplifies. What's your take on that deal? Is it feasible in your view?
Yeah, I think so. Yeah, I won't make a comment on the actual complexity of the deal. No M&A transaction's easy, in my view. But I think, when BHP looks at it, Anglo American has some great copper assets and has some tremendous assets in Peru. BHP wants to kind of expand its geographical footprint. There's great synergy opportunities in Chile, where Anglo has some great copper mines alongside Escondida. So I think there's tremendous opportunity there. And obviously anything that adds accretively to iron ore production is always a good thing as well, because that's, going to be continued driving. So whether the acquisition is successful or not, I think it really does put a spotlight on, I call it the tier 2 copper mining companies. They make really rich targets, and particularly this is disconnect between the markets, because I believe, mining companies are probably, undervalued right now based on their long-term outlook of mining, and, particularly in areas like copper. These assets are, pretty cheap compared to what the kind of cash flow and profits they'll probably start generating in the next 10 years. So this is the time to buy.
Indeed. I mean, one of the huge issues that the mining industry has been facing for, I had a guest on who is calling it a mining depression since 2010 to 2020, basically, is this idea of long-term funding where, China doesn't, these state-owned enterprises or whatever, like, it doesn't really hesitate, seemingly. I mean, from what I can tell over, on my computer screen, it doesn't seem to hesitate to put in, whatever it takes, and it doesn't even need to be profitable. Let's just get that metal going. As it did with the rare earth industry and, arguably is doing with the nickel and lithium industry. So how do you think the West can address this issue of long-term capital? Because it seems to be an ongoing issue. Like, is there a way to fix this?
That's a great question, Adrian. I often talk about the capital deficit. Actually, it has two parts, right? Which is capital discipline from the majors. So they're just not going to, I don't believe, invest in massive new projects. Last time the industry did that, we had the supply glut and destroyed shareholder value. So they're very disciplined in how they're employing their capital. And then the marketplace, really, it's hard to find capital for the mining industry, particularly juniors, et cetera. So, I think there's a couple of factors, but I think, mining's a high risk industry. They see a lot of these things going on, whether it's in Panama or wherever, and they just see high risk relative to other classes of investment that they have. So I don't think there's an easy solution. Government has a certain role in this, but it can't make up the deficit in capital that's required to build this production. So some numbers, to put this into practical terms, is Mike Henry mentioned, I can't remember, somewhere in the last 6 to 9 months, mentioned that to expand copper production to meet the needs, there needs to be an investment, a new production of like $250 billion. And that's not sustaining capital. And to date, only about $50 billion has been committed. So, that's a $200 billion deficit in just copper. And I have no idea where that's coming from. And we do see, the UAE and Saudi Arabia, the Gulf countries now, who want to become more dominant in the minerals intensive energy system. We do see capital flowing there from the UAE in some projects. Saudi Arabia has an ambition to invest $200 billion in mining in the next 10, 15 years. We're yet to see how that unfolds, but so that they are interesting sources of capital, that's kind of aligned. But it's hard to see where this capital is going to be coming from, honestly, from the marketplace.
Even still. The governments are concerned, mining CEOs are concerned. There's still no kind of obvious, okay, this is what we need to do.
No, I think, we're seeing glimpses, some private equity funds, putting together $1 or $2 billion funds, but the scale of things needed, it's kind of petty cash, to be honest. So, and then the other one is the dearth of investment in exploration. So, whilst exploration investment has increased, I think 15% year over year in 2023, it's still at one of its lowest levels ever. And over half of mining exploration goes to gold, so which is kind of interesting.
Right.
Yeah. So, there's not a lot left for like the critical minerals, key minerals, including copper.
Well, yeah, and let's discuss that. I assume copper, especially right now with copper above $5 and, it being such a crucial metal for the green transition, I assume copper is basically front and center. But again, you host conferences, you talk to government, you talk to CEOs. What other metals are people excited about right now?
Yeah, well, I think obviously nickel is one that gets people excited. There's been a lot of headlines, with the, oversupply from Indonesia, which has caused both mines to be put on care and maintenance in Australia, bankruptcies to occur, closures in New Caledonia. And now we're seeing, unfortunately, these riots in New Caledonia that have now been attached to nickel mining, which is interesting. So the latest articles in the Wall Street Journal. So, lithium, I think, is clearly one which is attracting a lot of attention. Those, to me, are the primary ones. To me, copper, nickel, lithium, and to a lesser degree, cobalt are the ones that are really attracting the attention of governments. So
now, what's so interesting about that is, copper, of course, there's a huge deficit, whereas with nickel, cobalt, and lithium there's a sense of it being oversupply, right?
Yeah.
So in a sense, those have the attention right now, but you might say for different reasons, I guess.
And one of the things that nickel has thrown up is the green premium. So,
right.
There are some countries are going, well, we need to have a green premium. And I know, in the discussions that I've been having with downstream companies and governments, firstly, LME has said, it's not going to create another market for green premium. We're seeing downstream companies still buying nickel, that is sourced out of Indonesian mines, because downstream companies don't want to pay more. And I think we just look at any other product that downstream companies buy. And I think plastic's always my proxy for this. As companies do want things that are produced in a better way, more responsibly, but they don't want to pay more for it. And, with plastic, all the food companies that use plastic are all like, we want to use recycled plastic, but we're not going to pay more for it. So they still buy new plastic because it's cheaper. So it's this dichotomy in the marketplace. So, and that in itself is an innovation challenge as well, right? So how you get there.
Right. It's interesting, of course. Yeah. And then we think of, I think it's Andrew Forrest from Wyloo Metals in Australia, and saying that we need to have this green nickel pricing at the LME. Otherwise, maybe we find a place to trade our metal and this sort of thing. And of course, there is going to be this market concern as far as, well, who wants to pay more? Put it this way, like you're in conversation with a lot of, decision makers, how seriously are people taking this issue of, say, green metal?
I think they are. I think there's two parts to this. One is, I think everybody wants to more responsibly produce metals, both in the environmental footprint, and it's not just emissions, it's water, air quality, etc. Socially. So I think everybody's agreed that's got to be better. But on the other hand, I don't think companies downstream want to pay more money because consumers don't want to pay more for green. I mean, that's just a fact. So we want it, but we don't want to pay more. So my view is that at some point in the future, and Adrian, I don't know when this is, that the base price in the market will be the green price, because there's enough production that's being, if you like, green metal produced. So anything that's not is discounted. So it's kind of the other way around. So you can argue that's a premium, but I think the market price becomes for green metal, and anything that's not produced to a certain standard just gets discounted. Well, I'll buy your metal, but it's a 10% discount. I think it's the other way around. You can't say, here's a base plus 10%. It's going to be, here's the base price, and that becomes responsibly sourced metal. Everything else is discounted. Yeah. But I don't know when that could be. That could be years away, Adrian. It really could be.
It's a persuasive argument, though, in the sense that, you can get your nickel from dubious sources, but you can't put on your label that you're an environmental company.
Correct. Yes.
Yeah, no, I think that's...
and that gets to traceability then, Adrian, right? We need to be able to, universally be able to trace those metals. So through the supply chain.
Right. Let's talk about that. And sometimes blockchain is brought up as a potential solution for that. I mean, what are people saying as far as traceability? Do you see action happening on this front, or is it all talk at this point? Is it theoretical? What are you seeing?
I mean, this is really difficult. There's been a couple of good pilots. BHP and Rio have done pilots using blockchain, but nobody's been able to achieve this traceability with bulk, at scale. And I think it's a big change. So you've got a combination of standards. So what are the standards that make that green in the first place? And ICMM is working on a consolidation. There's too many standards in mining. It's confusing. So there's an effort to consolidate those standards. B, then how do you make sure that metals, from different supply chains kind of bleed into a single flow of material? So you've got to be able to track those. So it's really, really complicated. So I, again, think we're quite a few years away, actually, from traceability, particularly for your large volume metals. It's not easy.
Interesting. So again, you do consultation. So what are CEOs really reaching out to consult about? Like, what are they looking for insights on, if you can generalize?
It's a great question. I think one is, how do I overcome the big technical challenges that are being faced? And particularly, these are technical challenges, but that are beyond the capacity of the existing ecosystem. So I think that's one, because the energy and water and waste intensity of mining and across a lot of material is just too high. Things like tailing dams. Nobody wants a tailings dam anymore. Mm-hmm. So I think these are massive challenges that are beyond, to me, a single industry. So I think, developing more collaborative models downstream, what's the role of government in that? So I think really interested in how you build those kind of robust partnerships to do that. I think the Indigenous reframe is huge. We have a partnership on one nonprofit with First Nation Major Projects Coalition in Canada. That's another biggie. Mm-hmm. And then I think how you work more effectively, I call it, how do companies and governments that work in a market-orientated world, by and large, compete with state-directed market shaping, I call it. So what are the models that you use to do that? And then the last one is I call market vulnerability. So other than the majors who can withstand price fluctuations because they have iron ore or coal, is companies that are pure lithium or whatever, they are very vulnerable to price dips. They almost get into, nickel companies, you get into extreme financial difficulty very, very quickly. So how do you protect those companies? Otherwise, you're just going to see when the market gets flooded, these companies collapse, and then the sole source becomes whoever tried to shape the market, right? That's not easy to do. That gets to the heart of this disconnect between, we covered a little bit before, disconnect between the outlook for the next 10, 15 years and the short-termism of kind of the market.
Right. I mean, exactly. Like in a sense, like the picture you paint is, I would argue, if you're to start making inferences, is not a particularly optimistic, like the prognosis doesn't seem to be particularly favorable to a outcome where in 2030 we're going to have green supply chains and it's all going to work out and it's going to be affordable and we're not going to have crazy inflation or whatever the case may be. Like, so I ask you, how optimistic are you on this situation?
It's interesting. It's almost a bifurcated world, I think. So if I was a mining exec CEO and the leading companies, I'm not uncomfortable. So because I know I'll be producing, if you want, green metals. If the prices go through the roof, I am not unhappy. If there's a massive supply-demand gap, economics work out. And if those prices are sustained enough for a long enough period to send market signals to capital, I might start aggressively expanding supply. So I think those companies are looking pretty happy. I think on the demand side, though, the downstream companies are probably not happy because they're going to, shortage of key minerals for energy work, extremely high prices, etc. So, that's the difficulty. And then that creates that tension, Adrian, back in. So then there's the other metals that maybe aren't being green produced. To what extent do I use those to meet the energy transition goals? So there's a massive trade-off there. I think the mining industry right now, putting all their own technical challenges, et cetera, aside, I think the industry has a pretty strong outlook, actually, in terms of performance, interestingly.
It's interesting. Exactly. Like from an industry perspective, the outlook's fabulous, right?
Yes.
It looks like supply demand, finally this kind of what someone was calling a depression in mining may be over. But the government, from their perspective, if all of a sudden you're talking to them, all of a sudden it's a completely different picture. It's like, well, I guess, optimistic for the miners. Maybe not so optimistic if you're government trying to figure out how to strategize and reshore the supply chain. So do you have any thoughts on that?
Yeah, I do. A couple of things, actually. One is, one of the challenges the industry has, and I think governments, because if you look at this peak demand, let's say an IEA kind of hits peak demand, an S&P analysis around 2035. The problem is that peak demand, Adrian, only goes for about 5 to 7 years, and then it dips down again. So I am not. Yeah, of a lot of the minerals. So the minerals, there's a peak demand and then drops off, especially copper. So why would I invest billions investing in mines that might have 40, 50-year lives when that peak demand I'm aiming at only lasts for a fraction of the time? So I've got to be a lot more disciplined and measured how I bring on supply. And if that happens, demand has to flatten out. That's one key issue. So that's not easy. I think demand just has to shift out. Two, countries are increasingly wanting to capture more downstream value from their resource endowment. And that doesn't matter if it's Australia or the African countries. Everybody wants to capture more downstream value. And we're seeing resource nationalism like Indonesia banning the export of nickel just from pure extraction, even New Caledonia. So but the question I have is, can you, as a country, if you're a high-cost producer like in Australia, how can you do more downstream value add when you're a high-cost producer, you have a small domestic market, and you're a long way from the actual markets of consumption? You can't create a competitive product downstream. So that's a real challenge for countries, is how you do that. The last thing is then, people often ask me recycling and how does that play into it, and substitution. So I think, to me, the mining industry, I think there's a shift that needs to happen, that we become materials providers, where we provide a material that has certain characteristics like copper. It's conductive. So we mine it. We should lean in more and more into recycling of the materials. So Vale and Glencore have invested to a degree in recycling companies, but also we work downstream companies how to use less of it, and then finally invest in substitution. So I think that's a smart strategy to become a more valuable company, to me. But people are talking about recycling having to, but it's, even if you went on steroids in recycling, it's not going to bridge the supply gap that exists.
Interesting. And just as we start to wrap up here then, so is that what's sometimes called the circular economy? Like, I assume that comes into these discussions at these conferences and whatnot.
Yes, increasingly, yeah. So I think everybody wants, everybody believes in the circular economy. How do you make that happen is critical, and who's going to do it? So, and we see a lot of investment going into battery recycling companies, and I'm not sure that anything's ever been reached at scale, to the volumes, but even, copper has a 30% recycling rate now, I believe, and Europe's a bit higher. And if you keep that as a constant, a greater production, that means doubling recycling. I think University of Queensland said for recycling to cover the supply gap, we'd have to recycle all the copper ever mined up to now. So it's just huge. So, the circular economy is important, but it's not going to solve our problems, that we have in the supply-demand gap.
Okay, excellent. And just as a final question, is there anything we haven't mentioned that you think we should be discussing here, or that you'd like to talk about in our discussion?
My final point, and we just scratched on it though, is I think that the magnitude of the challenges we have really demands a greater level of collaboration between downstream companies, whether it's auto OEMs, power generation, even wind turbine manufacturers, and the mining industry. Because I think the mining industry is a small industry from a market capitalization perspective. And I think the investment required to solve some of the challenges requires a lot more than just letting the mining industry try and solve it all by themselves. So that's one of my kind of big exclamation marks that I think we hopefully will emerge soon.
Well, it was very eye-opening, actually, when you were discussing, when I asked you what are some of the most common problems you hear from CEOs, and it's very much the technical issues, the real world, the challenge of the real world. Yes. As they say, mining is a difficult business. It's like you can't just write a paper. It's like the real world is the challenge here.
No, it is. Yeah. And the last one I will mention is, I call it the 20-year nightmare. How can we discover resources faster and not take 20 years to permit and develop a mine? I mean, that's just not sustainable anymore. So that's a huge challenge for the industry.
Indeed, that is definitely one way I think government could help out is with permitting times. And I think they are starting to hear that from the industry. So very good. Well, thank you for joining us, Peter Bryant, board chair of Clareo and the Development Partner Institute. Thank you for sharing your insights and observations on the industry, and do come back to the Northern Miner podcast.
Adrian, thank you very much. I'd like to be with you today.
Thank you once again to Apollo Silver for sponsoring this week's episode of the Northern Miner podcast, and also big thank you to Peter Bryant for appearing in this week's feature interview. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.